Today we're going to take a look at 7 adjustments, and I've got an Excel spreadsheet here. It's kind of dynamic. All the T accounts are shown here, assets on the left, accumulated depreciation is an asset, liabilities in the middle, and then here's the owner's equity on the right hand side. And I've got some formulas in the T accounts such that as we make entries into the T accounts, the balances of the accounts will be updated. Now, I've got 2 trial balances here. This first one with the dark green background is the starting point. So if you look at cash, for example, it's got a balance of $74,000, and that's its balance over in the trial balance. Accounts receivable, $32,000, etc. And in fact, the adjusted trial balance starts out the same way. But as we make our debits and credits into the T accounts, that lighter green trial balance, called the adjusted trial balance, will be updated. Trying to get across the idea that the account balances change. One of the challenges of adjustments is you've got more accounts to think about. And if I could give you a couple of hints here, we're trying to observe the revenue recognition principle and the matching principle. Revenue recognition has to do with earning revenue. Matching principle has to do with matching the expenses to those revenues. So I've got a little checklist here of the adjustments. Let's look at the first one here. It says $900 in the first one. $900 of supplies were used up this month. And we're going to have to go find our supplies expense account. Here it is right here. And put a $900 debit in supplies expense. And you'll notice that that supplies expense is going to get posted. The balance, we've only had one debit here, so our adjusted trial balance doesn't balance because we have to make a credit. Still debits and credits. So the credit will be to the supplies account for $900. And so to show the using up of supplies, we debit supplies expense. Supplies expense represents the cost of supplies used up, and make a credit to supplies. Okay, that's the first one. And notice your adjusted trial balance is in balance. Second one, we owe money to our employees, $2,100 that they've earned, and we have not paid them, but at the end of the period, we owe them that $2,100 of salaries. So you'll find salaries expense right here, $2,100, and that's money that we owe to the employees. That's going to be a credit of $2,100 to the salaries payable account. Third adjustment, here's a revenue one, and we have earned some revenue, but we haven't recorded it yet. And the way you handle that is by debiting accounts receivable $4,300, and find your revenue account. Here it is right here, service revenue, a credit for $4,300. And again, if you look at your adjusted trial balance over on the right here, it is in balance. Fourth transaction is also a revenue transaction. If you look in the liabilities, we've got some unearned revenue here of $8,500. And it turns out that $700 of that $8,500 has now been earned. So we're going to reduce the unearned revenue by $700. That's a debit. These are probably customers who paid us in advance, and now we are providing the service that they paid for. So a debit to unearned revenue and a credit to service revenue for $700. Take a look at your prepaid insurance. This is an asset that gets used up, and we bought a 1-year policy on April 1. It is now April 30th, and 1/12 of that prepaid insurance has now been used up. That's going to be a debit to insurance expense. Let's find that here. Insurance expense for $200, 1/12 of the $2,400, and that makes the prepaid insurance go down by $200, which will be with a credit. Adjusted trial balance still looks good. And we have taken care of number 5 now. Number 6, we owe somebody money on a note payable. Here it is right here, $80,000 that we owe. And we have to record the interest that has accrued on that note payable. We're not paying it, we're just recording the amount of interest that we owe. So on number 6, this is going to be a debit to interest expense for $25 and a credit to interest payable for $25. So here's a case where we owe the money on the note, and at the end of the accounting period we have to record the interest that we owe on that note. And then finally we have depreciation to record, probably on the equipment. That will be a debit to depreciation expense for $400. Here's depreciation expense, $400. And we make a credit to accumulated depreciation for the same amount. My guess is we probably bought that equipment a month ago, and we've already recorded 1 month of depreciation, and this is the 2nd month. All right, now we take a look at our adjusted trial balance. If we were to do financial statements, we would use this adjusted trial balance as our reference for the financial statements. These balances in the trial balance have been updated now. One thing you're going to see here on every adjustment we make is that we don't use the cash account. So here's the cash account, and we're not going to make any debits or credits to cash in the adjustment process. And so that's one thing you need to note. Adjustments are something you could memorize. That's probably the way most people would manage this chapter. But the pattern is that each adjustment affects one income statement account and one balance sheet account. All right, well, I hope that helps to clarify the area of adjustments. It is challenging. We are on the accrual system. We're not on a cash basis system, so the cash account is not used. And if you have no better way to learn this section, you could memorize it. All right, that's it. See you next time.